Group trading floor. Today's segment is Earnings Central still to drive. Can risk on continue, or will there be a dive after all the EPS is out of the way? Obviously, we still have issues. The last statistic, if you take a look, we still have just shy of 30 million rather, vacant homes in the U.S. Turning to the scenario that we still have in Europe that are still concerns, you saw the economic releases this morning, particularly in the UK. UK shrinks more than survey, -3% in terms of GDP, and they were looking for -1. So the threat there is that there is a triple dip recession possibility, which is a tough one to say. Focusing back on our earnings, I think if you take a look at it from a portfolio manager's point of view in terms of where there is less country risk, it's obviously the United States. So you're actually seeing a country asset allocation, if you will. The better performer is the United States equity markets. You're looking at 28% of the earnings that are currently in the S&P 500. Well, interestingly enough, about 5% of those are beating Q4 of 2011, suggesting that in its aggregate, the S&P has 5% earnings and revenue growth, which is fueling the 5% rally year to date. Because if you take a look at it from the beginning of the year to where we are now, we're up approximately 5%. Interestingly enough, to point out some other facts to you, if you will, 1576.09, all-time high, 1011.07. Pundits all over the place now are calling for, and we're talking about pundits in the banks particularly, calling for the index to possibly revisit that, considering the United States is not only showing earnings and revenue growth, but we're showing a job market that's beginning to perform, manufacturing, and China is back on board as well. So what that means is that we are essentially 5% shy of where that top level is if you take a look at where the index is now. If you also note, from the low, the hard bottom low, 1343 low, which was established on 11/16/12, which was in the election cycle, to where we are now, that is approximately 12% from that low. 5% more to take us to that all-time high really is not a big stretch of the imagination, if you will. We are the highest that we've seen since that low was 1502.26, which was just the other day, in fact. So what do we do at this point to go ahead and capitalize on all these moving averages way under there? Not really going to help us at all. 50-day moving average, 1431. The 100-day moving average, 1432. The 200-day moving average, 1396. Considering everything that's on the table, considering we still have a lot of earnings to go through, what are we supposed to do to participate in the move? We're getting dragged into this just as a lot of the other portfolio managers are, because you don't want to miss performance. So at this point, the recommendation would be the February 1505, 15 1/4 call spread. It's trading at about $5.50. That's the best shot to look at to go ahead and participate if this begins to continually fuel. Aside from that, play the moving averages smartly. Rich Canlione from CME Group, signing off. Thank you.